So welcome to the class. Sorry for being late. I was considering canceling the class, but we saw at least let's do something and then we'll continue tomorrow. So welcome back to those who are there in the morning class. So I wanted us to cover somebody brought to my attention some question here, which to be honest, it's not in the syllabus, but because it's there, I normally teach it in undergraduate and master's classes, but I've not seen it really in your syllabus. But because it's been tested, I decided to do it. Now, this is not relevant to CASNEB students. So CASNEB student, you can excuse yourself and you join us tomorrow. So this is only in ICPA. So if you're a CASNEB student, you're free to leave the class. You can join us tomorrow in the morning at 8 in Bisoke. So I hope I'm clear. So this is not in the CASNEB syllabus. So we want to continue from where we had stopped. Let's start by reading this question and then I'll introduce some concept and then we complete the question. Now, the question reads, Ganza, okay, it is as you can see there in the screen, it's you can note it down, June 2017. If you have the paper, you can read it, you can open it so that you read it. June 2017, question 4. June 2017, question 4. The person who raised the issue, thank you for raising that. So June 2017, question 4. June 2017, you can open it. It's a very unique question on ratios. So Ganza Rwanda Limited has been in operation for a number of years. Its directors are contemplating expansion of its operating activities into other parts of East Africa and require an evaluation of the company's cash flow. Evaluation of the company's cash flow as at 31st May 2017. The following statements of cash flow for the year ended 31st May have been provided for that purpose. So the company has been in operation. Its directors are contemplating expansion of the company's operating activities, and they require evaluation of the company's cash flow to know whether the company can expand or cannot expand. So the following statement of cash flow for the year ended 31st May have been provided. The reason why I'm covering this, remember in this sitting, there is almost a 99% probability of a question being in ratios, but I don't know which area of ratios. That is why I'm covering this question. That is the only reason why I'm covering it, because there is a very high probability that in this sitting, there will be a question on ratios. So the following statement of cash flows for the year ended 31st May have been provided for that purpose. So in the morning, we covered statement of cash flow. So this is a sample of a statement of cash flow. I've said it is June 2017 question, whatever question, June 2017 question 4. June 2017 question 4. June 2017, is it first of all June 2017? Let me just confirm. Yes, June 2017 question 4. June 2017 question 4. Okay, so we have been given the statement of cash flow. And then there is additional information. Net sales. So you have been given the net sales in the year 2017 and net sales in the year 2016. The liabilities for the period were, you have been given the liabilities, the trade payables, accrued liabilities, 15% bank loan. During the year, the liabilities for the, okay, you have been given the liabilities for the period. Please only avoid typing in the chat. You are forcing me to go back to the chat. Maybe I'm thinking that there is a question. You will write your details later on. By the way, I don't even need your details. We have finished the major part of teaching. We are just revising. I don't need your details. So just avoid writing in the chat. Let chat only be used for questions, please. So next, the liabilities are, and then you are being told, during the year, the management obtained an additional loan of 1.2336 billion with a grace period of 12 months to repay, of course. However, the directors resolved to repay part of this amount by 31st May 2017 to avoid any effects on the solvency of the company. To avoid any effects on the solvency of the company. So the company acquired additional land in anticipation of its expansion. So let's carefully read the question. Prepare a report to management of GRL analyzing the solvency, liquidity, and viability of the company using the information provided. How many marks? 20 marks. Normally, there are 4 ratios in cash flow analysis. That is what I want us to do. I want to give some background for 10 minutes, and then we go and attempt this question. So what is the question asking you? Prepare a report to management of GRL analyzing the solvency, liquidity, and viability of the company. And what have we been given? We have not been given the balance sheet. We have not been given the income statement. What have we been given? We have been given statement of cash flow. So can I go back and take some 10 minutes to explain this? Take note of this. Now, here, I've just gone to the slide on ratios. I want to continue with it. I was not aware this is in your syllabus. Sorry for that. So maybe 10 minutes to lay some background and then we solve the question. It is just on ratios, and they are very simple ratios to calculate, by the way, not complicated, and there are only 4 ratios. So I'll call the subtopic cash flow analysis ratios. You can take note. It will just be around 4 slides and we go back. So cash flow analysis ratio. Cash flow, that will be our subtopic, cash flow analysis ratios. So we can start in our introduction by saying there are normally 4 major ratios that are used to analyze statement of cash flow. It's good we did cash flows in the morning. There are normally 4 major ratios that are used to analyze statement of cash flows. So there are 4 major ratios that we use to analyze statement of cash flows. These ratios are, ratios measure the solvency, liquidity, and viability of the business. So these ratios are normally used to measure the solvency. The key word there is the solvency, the liquidity, and what? The viability of the business. Now, when we talk of solvency, these are ratios related to risk ratios. Ratios related to what? Risk. Long-term liquidity position of the business. These ones look at long-term liquidity of the business. Of course, the normal liquidity looks at ability to convert your assets into cash. Viability in this case is just looking at, is the business viable? In this case, ability of a firm to continue generating what? Income. Ability of a business to continue generating income. Remember, you can only continue to generate income if you have cash. So solvency looks at the long-term liquidity position. In other words, the risk ratios or the gearing ratios. Liquidity, on the other hand, looks at the ability to convert your assets into cash. Viability looks at ability of a firm to continue generating what? Income. So maybe the only new thing here is viability. Viability measures what? Ability of a business to continue generating income to meet all its financial obligations. So that looks at ability of a business. Viability looks at ability of a business to generate income to meet all its financial obligations. So here, what have we say? Okay, so there are 4 ratios. So these there are 4 ratios that are used to measure, what is it? Liquidity, solvency, and what? Viability when given statement of what? Cash flows. So remember, there are 4 ratios that we use when you have been given the statement of cash flow. So please, this is an important point when given statement of cash flow. So the first ratio is ratio number 1 is called current liability coverage ratio. Current liability coverage ratio. I've said there are 4 ratios. Current liability coverage ratio. Current liability coverage ratio. Sometimes this ratio is called current cash debt ratio. So sometimes it's called, so sometimes the ratio, we can start, sometimes the ratio is called current. If you want to know about these ratios, you can maybe go and look at a subject called financial statements analysis. At a subject called financial statements analysis, analyzing financial statements. There are normally 4 tools that we use, 5 tools that we use to analyze financial statements. You can get more of information on financial statements. It's a statements analysis. So sometimes the ratio is called current cash debt ratio. Cash debt ratio. Current cash debt ratio. Okay. Now, these ratios measures ability of a business to cover the short-term debts. Measures ability of a business to cover short-term debts. Of course, with its cash. To cover short-term debts. Ability of a business. Now, what are the difference between these? These are state ratios that are used to, but I think I've already explained them. The person called you, okay. I've already explained. What is the difference between these ratios and the ratios we covered? Even somebody can answer. These ratios are used to analyze statement of cash flow. Are used to analyze statement of cash flow. I hope we are together. The other ratios we covered are used to analyze what? Income statement and statement of financial position. I hope we are together. The person who asked that question, okay? So sometimes these ratios are called current cash debt. So we are saying these ratios measures the ability of a business to cover short-term what? Debt. Now current liability coverage ratio is equals to current liability coverage. Okay, current liability coverage ratio is equals to net cash from operating activities. Everyone knows how to identify net cash from operating activities. You divide by average current liabilities. You divide by average current what? Liabilities. I think this one is this is under operating activities. I think everyone can get that. Everyone should be familiar with that. So current liability coverage ratio, please write this formula somewhere. Just write it somewhere as I move to the next slide, so that when we start solving, we don't go back to the slides. So current liability coverage ratio, it is also called current cash debt ratio. It looks at net cash from operating activities. Everyone can identify these in a statement of cash flow. And I don't think there is anybody who does not know how to calculate average current liabilities. Average, you have two liabilities. Or if you have not been given two liabilities, you just use the current liabilities. You just use the current liabilities. So you can use current liabilities if there is no average current liabilities. Let's go to the next ratio. I hope you have put it down. New slide. I hope you've put it down. Next. So the next ratio, number 2, is called price to cash flow ratio. Price to cash flow ratio. Price to, the other one was current liabilities. This is now price to cash flow ratios. Sometimes the information given in a question cannot enable you to calculate this. Remember, when we talk of price, we are looking at the market price of the shares. If you have not been given, you don't calculate it. So price to current to cash flow ratios. This, it looks at, it compares the value of the company's share price to, it measures or compares the share price, in other words, market what? Price of a company to market price of a company to the cash flows generated. Everything here is about cash flows, to the cash flows generated. So price to cash flow ratio is equals to, price to cash flow ratio is equals to share price. Everyone knows how to get the MPS. Share price, if it is not given, you don't calculate it. Share price of an asset divided by operating cash flow per share. Operating cash flow, net cash flow, operating cash flow per what? Per share. You need to be given the total number of shares in order to calculate it. Again, please write these so that when we are solving it, you are aware of it. So that is called price to cash flow ratio. I said there were 4 ratios. So that is the second ratio, price to cash flow ratio. Price to cash flow ratio. Number 3. Number 3. Number 3, cash flow margin. Cash flow margin ratio. Cash flow margin ratio. Cash flow margin ratio. Cash flow margin ratio. Cash flow margin. So cash flow margin ratios compares the cash generated, to the sales made. What are the cash that you have generated to the sales that you make? To the sales that you make. So cash flow margin is equals to cash flow from operating activities. You realize everything here is operating activities. Operating activities divided by net sales. Divided by what? Net sales. Divided by net sales. Divided by net sales. Cash flow from operating activities. Of course, if it is a margin, you multiply by what? 100%. If it's a margin, you multiply by 100%. You multiply by 100% if it's a margin. Okay. Lastly, the last ratio, I hope we are together. Cash flow margin. Margin is sales. Margin is sales. That is why we divide by net sales. Margin is sales. You divide by net sales. So cash flow from operating activities divided by net sales times 100. I hope you've noted that. Lastly, that was number 3. Number 4. Lastly, number 4 is cash flow coverage ratio. Cash flow coverage ratio. Cash flow coverage ratio. Cash flow coverage ratio. So this again is cash flow from what? Operations. Of course, cash flow coverage. So what is the formula? Okay. Cash flow. Okay, let's first of all say this ratio measures the solvency of a business. Solvency of a business. In other words, it measures what? The risk of a business. What we were calling gearing, etc. So cash flow coverage ratio. Cash flow coverage ratio is equals to cash flow from operations divided by total debt. Total what? Debt. You know, leverage or risk looks at the debts. That is why we divide it by the total debt. So please take note of those as we now go and answer that past paper question. So we have talked of 4 ratios. What are the 4 ratios? Number 1, current liability coverage ratio, which is net cash cash from operating activities divided by average current liabilities. We have talked of price to cash flow ratios. It's share price over operating cash flow per share. We have talked of cash flow margin ratio, which is what was it? Cash flow margin. It was cash flow from operating activities divided by net sales. And finally, we have talked of cash flow coverage ratio. So let's look at an example. What is the example? June 2017. Was it question? Which question did I say question so that I go to it? Was it question 3 or question 4? Was it question 3 or question 4? Question 4, thank you. Question 4. So we can go to it. So please remember these 4 ratios. If the statement of cash flow has been given, remember those cash flow ratios. So let's go to this. So it is just that question. I hope I've captured everything. So in this case, you are being told, what is the question? Prepare a report to management of GRL analyzing the solvency. So in our title, it will be report. In other words, the topic title will be report analyzing the solvency, liquidity, and viability of the business of Ganza Rwanda Limited. Remember, it must be a report. So you know that is a title of a report. Okay, let me not put the word title. So you should just know that is the title of the report. The title of report. So, of course, you must put the date. You must show what else? From who? Who is it from? And who is it to? So in a report, you must give those items. The date, the particular date. What is the date? The balance sheet date, 31st May 2017. 31st May 2017. 31st May 2017. Who is it from? It's the directors are contemplating expansion and require an evaluation of the companies. The following statements. Its directors are okay. Have we been told? Prepare a report to the management of GRL analyzing what? Solvency. So who is it from? Okay, financial analyst or the accountant. From financial analyst. And who is it to? The management. Into bracket what? Directors. Of what? GRL. Please, when you have been asked to prepare a report, it must be a report. Okay, so it must be a report to the management. You are not been told it's the managing director, so just call it management. So in this case, now I know in a report there will be statements you will make, but let me start with notes. But notes, remember, come at the end. But I need them notes, or what we call working notes. But remember, this is not the beginning. This is at the end. These are working what? Notes in the report. But these come at the end. But you know, we must have working notes so that we prepare the report. We can say there are four ratios that are used to measure or to analyze statement of cash flow in order to measure solvency, liquidity and viability of the business. In order to measure solvency, liquidity and viability of the business. So we start with number one. What is number one? Current liability coverage ratio. Current liability coverage ratio. Current liability coverage ratio. Remember, we have 2 years. So what is the formula? Current liability coverage ratio is equals to, what is the formula that you have learned? The formula that you have learned is cash flow from operating activities. Cash flow from what? Operating activities. You divide by what? You divide by average current liabilities. Average or just current liabilities. Current liabilities. Average current liabilities. So you divide by that. So I'll have which year? I'll have the year 2017 and I'll have the year 2016. So we'll be in a position to get that. So what is the cash flow from operating activities? Cash flow from operating activities. Net cash flow, of course, from operating activities. What are our net cash flow from operating activities? These. We have 2,265,600. Remember, we are working in thousands. And this other side, it is 1,710,000. I hope everyone sees that. If you have the question, you can see. Were we given, somebody to check for me, were we given current liabilities anywhere? Were we given current liabilities anywhere? Somebody to current liabilities. Okay, on 2. Thank you. The liabilities for the period are trade payables, accrued, and 15 bank. Remember these 15 bank loans, 15% bank loan. This one is non-current liabilities. So what are the current liabilities? Current liabilities are these. So we can look at current liabilities. Current liabilities. How much is the current liabilities? How much? 39,32,600. How can I bring it? Current liabilities, there are two. There is, I'm seeing how trade payables and accrued liabilities. So trade payables and we have accrued liabilities. So trade payables and accrued, let me push this inside. Which note below? This is additional loan. These are non-current liabilities. Or during the year, the management obtained an additional loan of 1, 2, 3, whatever, with a grace period of 12 months. With a grace period of 12. So this is not a current liability. This is not a current what? Liability. What is grace period? What does grace period mean? You will repay it after 12 months. You will start repaying it after 12 months. So that does not okay. The company acquired an additional land. These is not current liabilities. It's not current liabilities. So accrued. Okay, let's continue. It's not a current liability. So I hope you are understanding me. 39, 32, 600. So this one is 39, 32, 600. And this other one is 28, 52, 600. 28, 52, 600. 28, 52, 600. Okay. Accrued liabilities 127, 400. 127, 400. And this other one is 187, 400. 187, 187, 400. 187, 400. 187, 400. Now look at this. So what is the total liability? Total current liability. Liability. The total current liabilities, of course, you can see it from there. The total current liabilities is that. Okay, please take note of this. And then what is the average? Average current liabilities. Somebody to help me. In this year, look at what I'm doing. In this year, it is this plus that. I hope we are together. Divide by 2. Average current liabilities. I hope we are together. Look at, before I click enter, what have I taken? The liabilities in 2017 plus the liabilities in 2016. That is, this is opening, this is closing liabilities. So divide by 2, that is the average. Here, we did not have 2015. So 2015, sorry. We did not have 2015. We were not given 2015. So 2015 will be 0. Will be 0. So you have not been given. So in this case, you just use that. Why do we use that? Because we were not given the amount for 2015. I hope we are together. So you use that. So are we in a position to get the ratio? So we are in a position to get the ratio. So current liability coverage ratio is therefore equals to, what is it equals to? Is equals to, of course, this divided by that. I hope we are together. I'm just trying to save time by doing that. So this divided by that, this divided by that. Are we together? So that divided by that. So what does it give you? It gives you that divided by that. It gives you, of course, it is not 1. If you want to have it as a percentage, you have it as that, as a percentage. Same to this. Please, you okay? You okay? The person, whatever called, you okay? You know, if I unmute, there will be a lot of noise. Type your question in the chat. So which ratio is that? That is which ratio? That is a ratio for the first ratio. So how did we get average current liabilities? Don't we have to divide 2 on? No, we don't need to divide 2. You know, we are assuming the business did not have any figure, in 2015. So you cannot divide by 2. That will reduce the value and it will be misleading. 15, how did you get the average in 2016? How did I get the average? There was no 2015. So if there is no 2015, you just use current liabilities. If there is no 2015, you just use current liabilities. Okay, thank you. Okay, so let's continue. So we have covered the first ratio. I hope we are together in that ratio. The second ratio, somebody to remind me, the second ratio was it price to cash flow? First of all, remember we only calculate the one that we can manage. Were we given market price somewhere? Were we given market price of the shares? If there is no market price, we will not calculate the ratio. Was there a market price somewhere? If there is no market price, we will not calculate it. Somebody is asking me for interpretation of this. What is the interpretation of this? You need to know, first of all, what is a current liability ratio. What did we say current liability coverage ratio is? It measures ability to cover what? Short-term what? Debts. Short-term debts. So your short-term debts are these. Your short-term debts are that. Remember, these are your short-term debts. Your short-term debts are those. And your cash flows are that. Are our cash flows in a position to cover short-term debts? No, they are not in a position to. If it is more than 100%, it is in a position to cover short-term what? Debts. If it is less than, it is not in a position to cover short-term what? Debts. So remember, what is the liquidity position? The business may suffer from cash flow problems because the cash flow generated from operating activities, which I remember when preparing statement of cash flows, we said operating activities deal with majorly current assets and current liabilities. We are not in a position to cover all current what? Short-term debts, all current liabilities. If it is above, the performance is good. We are in a position to cover current liabilities. If it is below 100, we are not in a position to cover current liabilities. We are not in a position to cover current liabilities. So let's go to the second ratio. I was asking, did the question give us market price? There is no market price. So look at what I'm doing. If there is no market price, I'll just write price to cash flow ratio. You give the formula cash to price to, let me just follow the format I did. So this price to cash flow ratio to cash flow ratio, or PCR, is equals to, what formula was it? Okay, I did not list it up there. Share price over what? Operating cash flow per share. Operating cash flow per share. So what will we say? We can come and say here, the market price per share, the market price per share, and the total number of shares are not provided. And therefore, we are not in a position to calculate price to price to cash flow ratio. And therefore, we are not in a position to calculate price to cash flow ratios. I hope you've understood that. So I've just given the formula, and market price per share and the total number of shares are not provided. So the person who set this question was really not an expert. Okay, so let's just continue. So the market price per share and the total number of shares, or maybe did I cut it out? I may have cut it out, but I don't think it is there. Yes, Galaxy, what does this mean? It means in 2017, we are only in a position to cover 64%. We are only in a position to cover 64% of current liabilities using our operating cash flow. So you can say operating cash flows can only cover what? 64% of the liabilities, current liabilities. Here, our operating cash flow can only cover what? 56% of the current liabilities. Let's go to number 3. Number 3. What was number 3? Was it cash flow margin ratio? So cash flow margin is equals to what did we say? Cash flow from operating activities divided by what? Net sales. I think these ones were given. Were we given net sales? I think we were given. Divided by net sales. So if we were given, we can come and just copy this. I'll come and paste it there. Cash flow from operating activities. So what is our net sales? I think we were given net sales in each year, if I'm not wrong. Net sales, yes, yeah, they are here. Net sales were 3024. 3024 000. And this other side, it was 2402 400. I think we can get the ratio now. CFM is therefore equals to, we can get the CFM. I just bring it there. That divided by that. Of course, I'll Somebody to help me in interpretation of that. What does that mean? In other words, the cash flow from operating activities in proportion to sales. The cash flow margin was 75 what? Percent. The cash flow margin was 75%, and this other side it was 70%. The cash flow margin finally, number 4. Number 4 is cash flow coverage ratio. Cash flow ratio. Cash flow coverage ratio. Cash flow coverage ratio. So cash flow coverage ratio is equals to cash flow from operations divided by total what? Total debt. Total debts. Your total debts. Were we given debts? So during the year, the management obtained. So, okay, so let me just bring this first. I'll copy that. I'll come and post it there. And then okay, so next I'll look at total what? Total debts. So somebody to help, what are our total debts? So during the year, the management obtained an additional loan. First of all, let's look at the statement of cash flow. Financing activities. Do you see further loan received is 1, 2, our loan at the end of the year. At the end of the year, this is at the end of, I was just looking at the movement in operating cash flows. So here at the end of the year, 15%, somebody was asking for about 15%. At the end of the year, the debt was this. At the end of the previous year, it was that. During the year, the management obtained an additional loan of 1,233,000,000, whatever that is, with a grace period of 12 months. However, the director resolved to repay part of the loan amount by 31st May. So my question is this amount part of this 14? Is it part or is it not part? You can type for me in the answer. Is it part or is it not? Robert, what are you asking? In financing activities, we have further loan that is the same as what we have in information 1. Thank you. That is why I'm asking a question. That is why I'm asking a question, Robert. That is why I'm asking a question. What I'm asking is this additional information 1 part of this? The answer is yes. How do you know it is part of this? We always look at this change. In the statement of cash flow, where is it? Statement of cash flow. Do you see financing activities? This 1,233,600 was the further loan what? Received. Further loan received, which means there was a loan that is repaid here. There was a loan that is repaid here. So the further loan received is included there. It is included there. It is part of that. It is part of 14, because remember, if there is a new loan, the new loan, there should be a difference between this and that. There should be an increase. However, in the statement of cash flow, you are also being told there was a repayment. So repayment, there is repayment in this case, and there is what? New loan. That is why you see there is a decrease here. There is a loan that has been repaid. How much loan has been repaid? A loan of 1,617,600 has been repaid, but we have also borrowed a further how much loan? 1,233, whatever that is. So if this examiner was accurate, look at this. Somebody to get me the difference between 18 and 14. What is the difference? Maybe the difference between 18, I'm getting the difference, you know, that is a picture. I cannot get it directly. 16000, and this other one is 18. I'm just hoping that the examiner was right in the figures he put. That is my hope. So what is the difference between the two? The difference between the two is this. I'll rub what I'm doing there. I'm just using it to confirm. The difference is 18 minus that 380. 384, thank you. Now we come here. Where is it? We come, were we told? Here we come repayment. Do you see in the statement of cash flow? How much did we repay? 1617600. 1617600. 1617600. That is the amount that was repaid. Remember, this is repaid. I'm just confirming something. And how much new was received? The new that was received was 1233600. 1233600. Is it? This is what? Received. So when you get the difference between these two, this minus that, it is these three. Thank you, it is correct. Have you seen the reconciliation that I've done to confirm the figure? Do you see they are the same? I hope you've understood what I've done to confirm the figures. It is the same. What do I mean? Let me explain what I'm explaining. I mean there. There was an amount that was repaid. The amount that was repaid was 1617 million. This one here. 16 was the amount that was repaid during the year. Now, look at that. The new amount that was borrowed during the year is this. So the difference between the amount that was repaid and the amount that was borrowed, the amount that was repaid was more by 384. And then if we come here, where is it? If we come here, we are getting the difference between this and that. The difference between this and that, it gives you how much? 384. It means this new loan was included there. That is what I was confirming. I was confirming that. Joyce, you are confusing. But the 384 was for 2016 on repayment. No. Remember the amount. First of all, which 384 are you referring to? Which 384? Oh, sorry, I've interfered with my figures. Which 384 are you? So please note, these three, what happens when it is not included? When it is not included, you add the new loan. The person who has asked that, when it is not included, you add this 1, 2, 3 to this 1, 4. When it is not included, you add this plus that. You add this plus that. Joyce, 384 is the difference between 2 years. It is not for 2016. It is the difference between 2 years. So I hope we have confirmed, and now I can conclude that the total debt. What is the total debt? I can comfortably know that I was just confirming the total debt. The total debt is 1416. 1416000. And this other side, the total debt is 1800000. So 18. So all these I can now remove them. I was just using that to confirm. So the total debt. So here, what do we have? Cash flow coverage ratio. Cash flow coverage ratio is therefore equals to cash flow coverage ratio is therefore equals to, somebody can help me, is equals to this divided by that. It gives whatever it gives you. So that will give you in this case, it is only these total debts. You can see this. Your cash flow compared to the total debt. This is the only ratio that shows that the company is performing well in the year 2016. But in the year 2015, just because it's performing well because we repaid a big debt. Had we not repaid that debt, the company could still not be performing well. I'm not using total debts. What am I using? The person asking me, we are not using total debts. Now, my friends, liabilities, if there was short-term loan, if there was a short-term loan, is when we could have picked it from current liabilities. I hope we are together. If there was these are not loans, trade payables are not debts, accrued liabilities, in this case, if there were short-term loans, is what I could have used. Remember, what does a cash flow coverage ratio measures? It measures the solvency. In solvency, we use long-term debts. In solvency, we use long-term what? Debt. What is solvency? Solvency, we use long-term debts. Solvency uses only long-term debts. Solvency uses long-term debts. Any question? Now, can I ask you a question? The question that we covered in the mock, is it direct or is it not direct? If it is direct, I may not cover it. Is the question in the mock easy? That one is the normal ratios we covered. Is it easy to do? I thought that this June 2017 was the difficult one. That is what I wanted to cover. Can you please give me your opinion so that I know how to plan? Of course, now I cannot even do it right now, but I just want to know your opinion. Are you in a position to cover the normal ratios, leave alone the cash flows, so that I don't go to it? Normal ratios. Normal ratios should be, you should be in a position to do. You should be in a position to do. You should be in a position to do normal ratio. So remember, these were working notes. There are 4 ratios that are used. Now, besides these, you can now explain, you can explain these. You can now explain, how can we do our explanation? Like, for example, now I'll come to my interpretation. Interpretation, which is now part of your report. Interpretation is now part of your report. Interpretation, in the current liability ratios, in the current liability coverage ratio, in the current liability coverage ratio, we are done with, we are just interpreting, and then I think that will, in the current liability coverage ratio, we find that, remember, you are doing a report, so you must explain in a language that the directors can understand. In the current liability coverage ratios, we find that the business can only cover, the business can only cover, what can it cover? 64% of current liabilities in 2017, and what? 56% of liabilities, current liabilities in 20 what? 16. In 2016, with the cash flows generated from operating what? Activities. This means that the business will look for an additional what percent? 36% financing in 2017 and 44% financing in 2016 in order to cover all current liabilities. Do you understand the report? Do you understand, or there is something I need to explain there? Do you understand this interpretation? I hope it is clear. I hope that interpretation is clear. Okay, if it is clear, we can move to the next one. So we have explained current liabilities, price to cash flow ratios, information provided by the accountant. So we can say here, information provided by the accountant to us was not sufficient to enable us calculate and interpret, to enable us calculate and what? And interpret price earnings what? Ratio. The accountant should be asked. Remember, we are finance analysts, we are not accountants. The accountant should be asked to provide us with information on what? On market price per share and total number of shares in the year what? 2017 and 2016. That is that area. We've interpreted that. Next interpretation. The next interpretation is on cash flow margin ratio. Cash flow generated from operating activities in 2017 is 75% of net sales. While cash flow generated from operating activities in 2016 2016 is what? 71%. Is 71% of net sales, of net sales, of net sales, of net sales. So it means 2017 performed better than 2016. Finally, we have, what do we have? Cash flow coverage ratio, which is cash flows over total debt. So in 2017, the cash flow generated from operations was enough to cover all what? To cover total debts, long term, of course, long term, to cover total what? Debts. It was what? 160. The cash flow, instead of using the cash flow was what? 160% of what? Total debt, which means that the business is in a position to comfortably repay its what? Debts. To comfortably repay its debts. These may have been contributed by this ability, this positive performance in 2017 was contributed to by the business repaying a debt of, how much did they repay? Repaying a debt of 1617 600. I hope I've captured it well. During the year 2017, and therefore the total debt reduced. In 2016, before the major repayment, the cash flows, the operating cash flows could only cover 95% of the total debt. And that is ratios that are used to interpret, Why can we not talk only on 1 year, on year 2017, to interpret on number one? What do you mean by number one? You must compare 2 years. You must compare if that is what you mean, you must compare 2 years. That is why I'm saying here, I started with 2017 and then I finished with 2016. You must compare 2 years. Any other question? Please practice on this. The probability of having ratios is very high. But what I don't know, which ratios will be asked. Will it be ratios that affect the balance sheet and income statement, or the ratios that affect statement of cash flow? So to be safe, revise both. I hope we are together. I want us to stop there so that we have energy for tomorrow at 8. So let's meet tomorrow at 8. I think tomorrow at 8 we will start with published accounts. Published accounts tomorrow at 8. Let's keep time. We will meet in Bisoke tomorrow at 8. You can all come. I've opened the window for all of you. You can all come for the class, but make sure you keep social distance in the class. So you can all come to the class. Have a good night. Let's meet next time. I will share this tomorrow. I'm too tired to even share it. Remind me tomorrow when we are in class, I share this. I'll share it tomorrow. Remind me tomorrow when we are in class to share the workings, please. Not today. Okay.